All right. I imagine you're busy studying for the test or taking the test, or maybe you already did take the test. But time goes on, and I'm going to lecture about chapter 7. And we have a special guest joining us here. This looks like Jonathan. Hi, Jonathan.
Hey,
How you doing? Good to have you
I'm
aboard.
doing, yeah, thanks. I'm kind of tired.
Okay. Did you take the test yet?
The exam, no, not yet. I don't think I'm gonna take it today. I just took the first quiz and yeah, my mind isn't working right.
You got to get in there at the right time. Hi, Christy. How you doing?
Hi, good, Bob. How are you?
Good. You getting ready for the test, I hope, huh?
Oh, yeah, definitely. Yeah. But the
All right.
emails have been very confusing, just so you know,
The emails from who? Me?
from Canvas and from the what's her name, Cornelia.
Oh,
So
really?
yeah, because we've been getting emails, telling us about stuff being graded, and then
Okay.
also about moving out of quiz results or quiz testing.
Okay.
So dates were moved out on the quizzes.
Yeah, yeah. Yeah, I'm not sure
Uh,
what that's about. I don't know if I was copied on that stuff. I'm not sure I've
And
even
then
seen.
the other thing is the reminders of the lectures are still showing it. And you can correct me if I'm wrong, but I'm guessing that we should be on chapter 7 at this point.
Yeah, we're still behind on that.
Yes, it's still behind.
Okay. You told me about that. I did mention it to my boss, but I did so in a phone conversation. And maybe
Yeah,
didn't.
so just so you know, I mean, I'm fine with the fact that we're on chapter 7,
Yeah,
because I know that we are ahead, but
yeah.
again, I don't think the class really knows that, and so it's made for some
Uh,
confusion.
All right, hold on here. Let me see if I can get in here. And we want to get in there and open up chapter 7, which is about banking and bank reconciliation. Chapter
Right.
7.
And one more thing.
Yes, go right
we
ahead,
get
Christy.
what we got saying that the Memorial Day was May 31st. So we're getting these automated emails. I don't think that she's seeing the fact that these emails aren't correct. So we did get an email saying that let's see if I can find it. Yeah, says, yes, Memorial Day lecture is on at noon
And when did you get that?
this morning at 9:33 a.m. So just, yeah, I mean, just kind of aware that this is it's an automated, I understand it's probably automated and she doesn't even realize this is happening.
Yeah, I will. The problem I'm having is she's in Germany.
Right, so there's a time difference, yeah.
So yeah, I got to figure out a time to go over because I remember you telling me very clearly about this, and
Yeah, so
I did mention it. So
yeah, just
have a bit of a workaround. All right, chapter 7. Are we ready for chapter 7? I think so. Okay. Yeah, we'll go into chapter 7, even though you haven't even tested on chapter 6 yet, but that's the way it goes in these short sessions. You can always come back and look at the video whenever you wish. Chapter 7, accounting for cash. Accounting for cash. What is cash? Cash is coins and bills and checks and money orders, cashier's checks. It's direct deposits, it's wire transfers, it's even credit cards. As far as I'm concerned, credit cards are cash as well. Cash, we love cash. What is internal control? Companies naturally want to protect their assets, especially cash. So they have a system of what are called internal controls to do just that. And they can range from the very simple and obvious, lock the money up in a safe at all times, to having different people do different things when it comes to handling cash. You don't want one person with all the power to receive the cash in the mail, fill out the deposit slip, bring the money to the bank, record it in the ledger. If you have one person doing that, you're inviting yourself into some big trouble. It would be a great temptation for that person to start stealing, and they could do so very easily and get away with it for a while. I think we know how to use a checking account. Would you agree, Christy?
Oh, yeah. That's
I-
one of the first things I learned in high school.
Yep. So we'll try to get past this. The USA Patriot Act. I've never seen this come up on a test, but what is it? It was passed in 2001 and helps to detect terrorism. Banks have to have this code number now. Opening a checking account. We know what a deposit ticket is. Know the different types of endorsements, okay? The endorsement is the act of signing the back of the check, and there are different kinds. And let's know these pop up on the test, and it's good to know if you don't already. A blank endorsement, that's simply where you sign your name on the back of the check. That makes the check payable to almost anybody. So if you got your paycheck right now and you signed the back of the check, and then you lost the check on the way to the bank, almost anybody can pick that check up and maybe get away with cashing it, okay? So you can protect yourself with what's called a restrictive endorsement. Instead of just signing your name, you write on the back, for deposit only, and sign your name, or paid to the order of Union Federal Bank or something, paid to somebody. So a restrictive endorsement is a very good idea. I was in that habit for years and years, always writing for deposit only on the back of the check. So know the types of endorsements. There's a
Now it's for mobile deposit only.
What's that?
Now it's for mobile or electric deposit only. So
Yeah,
everybody's doing
yeah.
it online.
Absolutely. You're absolutely right. I'm one of the few people who doesn't have direct deposit for my paycheck. And the only reason is it's a social thing. I go across campus, forces me to walk over there and do my comedy act for the payroll department.
Yeah.
Seriously, that's the only reason I did that. Do we know what an ATM is? Are you familiar with an ATM?
Yes.
You are. Wow, you're really on top of these things, huh? And a PIN number, huh? We know what an ATM is. Writing checks. Know these terms here, Jonathan and Christy. The drawer, the drawee, and the payee. And this can be a little bit confusing. The drawer, the depositor who orders the bank to pay the cash. The drawer, that's the person that wrote the check out. The drawee, the bank where the check is drawn. The payee, the person being paid the cash. Just know these three differences: drawer, drawee, payee. And I still get confused by the drawer, drawee. Steps in preparing a check. We're not going to go over this really. I don't think we need to do this. Check stubs. The bank statement. We're going to get into the bank statement a little bit. The bank statement's going to always show you the balance at the beginning, and then it's going to show the detail of all your deposits and all your checks written and ancillary charges. And with the bank statement, they're talking here, you get the canceled checks back, but you don't see that anymore, I don't think.
No.
You don't even get the images anymore unless you want them.
Right. You have to go to your website, your online banking, and click on the little icon to actually see it. Some actually still show it in the statement, but very few do.
Yeah, absolutely. So we'll just take a quick peek at a bank statement. Not that this is terribly tough, but this is what you're going to be working with when you do what's called the bank reconciliation. And notice that there's a beginning balance of 27,21.51, and they're saying they had so many in deposits, so much in deposits, and so much in deductions, and then they detail it out in chronological order, going from the beginning to the end of the month. And when we get to the bank reconciliation in a moment, you're going to see how you cross off these different items when trying to reconcile your bank account. Okay, here we go. Now let's get into the guts of the chapter. Preparing a bank reconciliation. Everybody should reconcile their bank account. It's probably the most important internal control, I think, a company can put into play when it comes to protecting cash. On any given day, the balance in the cash account in your checkbook, it's not going to be the same as what's on the bank's books. And this is due to timing. It's due to timing. It's not due to errors, probably. Transactions are recorded by the business at a time different from the bank. We write a check today and we record it in our financial statements in our checkbook, and maybe that check doesn't get processed by the bank for a couple of weeks. That's called an item in transit, and that's what we're going to talk about, how we need to reconcile the bank statement. And also, this is another thing you want to make sure is done by somebody different than others involved in the cash handling process. So we call these timing differences. Here, a deposit on April 30th didn't reach the bank until May 1st. So when we got the bank statement, we don't see the 600. That is a deposit, what we're going to call a deposit in transit. And same thing with the check. The check can get there afterwards. Understand the terms, deposit in transit. These are checks written by our customers that we have put into our checkbook, but the bank has not received them yet or processed them. You know, it's the end of the month. You opened up the mail and there were 5 checks there from customers. You did your job. You entered them into QuickBooks or whatever your system is and updated the checkbook. And then you didn't bring them over to the bank until 3 or 4 days later. In the interim, the bank statement was prepared and sent to you. So you have these deposits in transit. Outstanding checks, those are checks that we wrote, but they have not been presented to the bank for payment before the statement's prepared. And checks can be outstanding for a long time, depending on circumstances. I mean, where I used to work, salesmen would turn in their expense reports and they would spend hundreds of dollars and it would be rather complicated. But when the smoke cleared, we owed the salesman $3.08. And so the system generated a check for $3.08. He sticks it in his wallet and forgets about it. And the check remains outstanding month after month. So you finally have to go after the guy. And banks will charge us for things like check printing and processing. There'll be interest expense. There can be all kinds of things, minimum balance charges. So know your terms, deposit in transit, checks written by customers the bank's not received, outstanding checks, those are our checks, and service charges are things the bank is going to surprise us with at the end of the month. What are some other differences? Collections. Maybe we loaned money to some people and they're making the payments directly to the bank. We open up the bank statement and we see, oh, how nice. Jonathan paid back part of the note he owes us. He sent it directly to the bank as per our agreement. Well, we look at the bank statement and there it is. We don't know that yet. So that's another type of difference. Collections, you can call these collections on behalf. Here's the good one, NSF checks, non-sufficient funds. These are the bounce checks. These are checks that were written not by us. We don't bounce checks, but they're written by our customer. We deposited the money in good faith and then find out a week later when we get the bank statement that there was no money in the payer's checking account. So we have that difference to reconcile. And they're talking about errors made by the bank or by the depositor. Forget about errors made by the bank. We don't put that on the test. Believe me, if there's going to be errors, it's going to be done by us, not Wells Fargo now. Well, I don't know if I trust Wells Fargo, but by the major banks. Preparing the bank reconciliation, huh? Well, we're going to start with the balance per the checking account. And we're going to look at the balance per the bank, and we're going to adjust each one of those in separate columns until we come up with an adjusted balance that is the same for both the bank and the company. So preparing the bank reconciliation, start with the bank number. That's the easy one. Get that done and out of the way, because all you need to do is start on your first line. You write down balance per bank at November 30th or whatever you're doing. The next line, list the deposits in transit, checks written by our customers that the bank has not yet received. Add up the deposits in transit. Then list all the outstanding checks, the checks that we wrote that the bank has not received yet. So your template is simply the bank balance plus deposits in transit minus outstanding checks equals the adjusted bank balance. We're not going to have bank errors in anything we give you test wise, and I hope even homework wise. So we identify the deposits in transit, compare the bank statement. You're going to have the bank statement sitting in front of you, and you're going to be sitting at your computer screen, where you're going to have a manual check register in front of you, and you're going to be checking these off one by one. Last month's deposits in transit should all be on the bank statement. Deposits listed in the accounting records, if it's not on the bank statement, it's a deposit in transit. Individual deposit amounts in the accounting records, if they differ, you have an error. And that can happen where someone sends you a check for $317.58, and you accidentally enter it in as 85 cents into your system. And then the bank gets it, and all of a sudden you have that transposition error divisible by 9. You're off by 27 cents. So those things can happen. And like I say, if there's mistakes, we're going to make them, not the bank. Do the same thing with your outstanding checks. You're going to sit down and cross off every single check you see on the bank statement that's cleared. You're going to see, okay, check number 13 is on the bank statement. I'm going to take a pencil and cross it right off and do the same on our side. Check mark the stub or the accounting record, make sure the check is cleared. Checks written but not cleared are outstanding checks, and they are subtracted from the bank balance. Identify additional reconciling items. Well, you're going to see things on the bank statement you don't know about. You're going to see charges perhaps for interest for a minimum deposit amount, maybe a charge for printing checks. I bet there's going to be a charge for an NSF check. If one of your customers bounced a check, the bank is going to charge you $20 probably. And that's $20 you have to get back from your customer. So look for the items that are on the bank statement that you don't know about. They're going to get added to the company side of the bank statement. Let's look at a little bank statement, huh? A bank reconciliation. Bank reconciliation. They are telling us that there is a deposit of $637.02 on November 21 has not been received by the bank. Okay. This is a deposit in transit, and we're going to add deposits in transit to the bank statement balance. Checks number 219, 24, 27 are outstanding. The amount of these outstanding checks is then subtracted from the bank statement balance. So let's go ahead and see how they present it here. Look at your bank statement side. I suggest you always do the bank statement first, because that's the easy one. Bank statement plus that $637.02 they just talked about, minus those 3 checks, gives us a new balance of $209,233. They did not mention this beginning balance of $1748 on the prior slide, but there it is. $1748.09 plus the deposits in transit, less the outstanding checks, adjusted bank balance 209233. You're done. You are done with the bank side. Done with the bank side. So let's see what else we have now. Let me go ahead again here. Let me just show you something. Get used to the template. The template, bank statement plus deposits in transit minus outstanding checks. And then below it or next to it, you start with the balance per the checkbook. And you add different things that the bank is telling you that you didn't know about. That's what a bank reconciliation is. You're telling the bank on paper things the bank doesn't know, and the bank is telling you things you don't know. So let's see what we have here. Uh-oh, we came up with a mistake. Check number 214 was written for $18.98, but it was entered into the system as 1988. So there's a 90-cent error. We wrote a check for $18.98, but recorded as 1988. Hooray for us. We have 90 cents more in our books than we thought. So take a peek here. Your book balance is $23.93.23. You add that 90 cents there, and that looks like the only additional adjustment. Just add them up and come up with a subtotal. We come back and we look at the other items. Well, the boss went out and withdrew $100 on November 13th, but we never recorded it. We didn't even know about it. We're just finding it out now from the bank statement. So there's $100, and that needs to be pulled out, as you see right here, unrecorded ATM withdrawal. And then you have the famous bounce check and NSF check, non-sufficient funds, $200. That gets deducted from the book balance, from the general ledger balance. And finally, there was a fee of $1.80. We looked at the bank statement, see the bank charges $1.80 for some reason. And there we go. So what do we have here? We have an adjusted bank balance of 209,233, and we have an adjusted book balance of 209,233. We have now reconciled the bank statement. Now that's a real simple one, and they can get much more complicated if you've ever done these before. The bank, like I said, the bank reconciliations, a super important internal control. What this shows us here, Jonathan, is that we've accounted for every penny. We have pretty good comfort that our cash is under control. What if we did this, Jonathan, and we came up and we found out that the adjusted book balance turned out to be something like $2 or, some crazy number? That would tell us that we have maybe fraud, maybe somebody stole money, or we have a super huge mistake that needs to be addressed. So that's just a quick look at a bank reconciliation. Bank reconciliation. Now, as you might think, when you're being given information by the bank that you didn't know, you have to record that into your checkbook, into your general ledger. Okay? So only two kinds of items appearing on a bank rec require journal entries. Anything we get from the bank, errors in the depositor's books or bank additions and deductions. In other words, anything we pull from the bank statement is going to require a journal entry because we did not know about it. Looking back at the bank statement again here, the bank reconciliation, you don't need to write a journal entry for the deposits in transit. We already know that. That's what we're telling the bank. Same thing with the outstanding checks. We've already recorded it. My point being, there are no journal entries required on the bank side of the reconciliation. On the Company side, the book balance side, the checkbook side, yeah, these guys all require journal entries. So let's see what we have here. Let's see what we have in terms of these things. Looks like we had the ATM withdrawal. We had the NSF check for 200 and a bank fee. And we found out we had 90 cents more than we thought we did. Each one of those requires a journal entry so that the balance per the checkbook will now equal the bank statement. So let's see what we have here. The 90-cent error is 90-cent item is an error in the accounting records that occurred when the check amount was incorrectly entered. Assume that 1898 was in payment of an account payable, which had been incorrectly debited for 1988. So we debit cash and we probably credit accounts payable because when we wrote the check, we're making an assumption here that we're paying off a vendor who had given us credit. Okay. If it wasn't accounts payable, then the credit might be supplies or whatever we purchased. Okay. The ATM withdrawal. Okay. James Maple went to an ATM. He withdrew $100 and we haven't recorded it yet. We didn't even know about it. Now the bank statement comes and we say, uh-oh, the boss took $100 out. So you talk to your boss, Ms. Maple, Mr. Maple, did you take this $100 out? And what was it for, please? And he'll say, well, it's for my personal use. I took my wife to lunch that day or something. Well, you now know it's a drawing. You're going to debit drawing. You're going to credit cash. Remember the bounce check? Here's the bounce check for $200. The NSF check was deducted by the bank, because it proved to be worthless. Well, if the bank took it away from us, we have to take it away from us too, because we think we still have this $200. So our journal entry is going to be, of course, a credit to cash and probably a debit to accounts receivable. In other words, when we received the money, we debited cash and we credited accounts receivable. So all we're doing now is reversing that entry. And I think there was one more. Oh yeah, the bank service charge, $1.80 is a fee for services received. The bank deducted it from our account and we have to do the same thing. So we're going to credit cash. And in this case, they're calling it miscellaneous expense. Most companies have something called bank service charges, bank fees, names like that. So that's a look at the journal entries. Let me point out one more time, no journal entries done for the bank side. None done for the bank side. None at all. And let me give you one other tip. Every adjusting entry resulting from a bank reconciliation involves cash. You're going to debit cash or you're going to credit cash. There's no exception to that. It can be tempting. You look at it, you say, that means the accounts receivable is no good. So we fix the receivable, and then you get confused by saying, yeah, we bought supplies or we sold supplies. Cash has to be debited or credited. Electronic banking, we all do electronic banking. You really don't have too much choice in the matter. Let's talk about a petty cash fund as we get through this chapter. This is kind of a quick chapter. Petty cash, that's just a little box. Just imagine a metal recipe box sitting on in somebody's desk drawer. It's locked up and it's used to pay tiny little bills that come in, tiny little things for which we need to pay right away. And it's too small to worry about paying with a check. The petty cash fund. It's set up to pay for small, petty, hence the word, items. And to establish the fund, we write a check payable to the petty cash custodian. If you were the custodian, Jonathan, we would write the check check written payable to Jonathan. You would then take that money to the bank, cash it, and bring back $200, say $200 in maybe a few tens, a few fives, singles, and coins, a couple rolls of quarters, dimes, nickels, whatever. And that would be put into your desk under your responsibility. And the custodian should be the only one authorized to make payments from the fund. So you've got that locked up in your desk all day, Jonathan. People come in, the UPS guy comes running in, he's in a hurry. He says, look, you owe me $2 on underpaid postage. Well, of course, you're not going to tell the guy, okay, we'll pay you in 2 weeks when we run checks. No, you'll hand the guy $2 and he will sign a slip of paper called a voucher that you will have in a pad in your petty cash box. He signs off and you now know what to do. You give him the $2 and you write on the petty cash voucher, you write something like overdue postage so that you know how to record it at the end of the month. We're not recording it into the ledger at that time. We're going to be doing it at the end of the month when we reconcile petty cash. Petty cash fund example. Please notice that we're setting up a $100 petty cash fund, and petty cash is just another cash account. We're going to debit petty cash and we're going to credit cash. So we established the petty cash from $100. You have $100 in your desk in the form of some $5 bills, singles, and coins. And there's a typical example of a voucher. You sign it, and so does the person getting the money. At every moment in time, that petty cash box has to have $100. Every second of every day, there's $100 in there, either in the form of cash or signed vouchers. The signed voucher amount plus the cash must add up to $100. During the month, you're going to enter all these payments into a Excel type spreadsheet. And they don't show you the spreadsheet here, but it's not that important. But you're going to list them into the spreadsheet here and then summarize everything. For example, you might have a column for postage expense. And during the month, you had 8 incidents of having to pay out postage. Well, in this report, you just get the total postage, and that becomes your debit to postage expense. Same thing with travel, entertainment, whatever the main ones are that you want to isolate. Now, the month is ended. The month is over. We're going to replenish the petty cash. The petty cash fund should last you 1 month approximately. If you're turning over the petty cash fund once a week, that's too often. There's a problem there. You either don't have enough in the petty cash fund to handle these small nits that come up occasionally, or you're paying things that are too big. You're paying something for $23 that should more properly be done with a check. So the petty cash should last you approximately 1 month. To replenish the fund, debits are made to the appropriate expense and cash is credited. Well, that seems pretty easy, huh? Because the petty cash payment record is not a journal, no postings done from the record. A separate entry must be made to replenish. So let's see what they're talking about. Petty cash replenishment. At the end of the month, the petty cash fund had 8 vouchers and only $11.20 in cash. So those 8 vouchers, if everything was done perfectly, should have equaled $188.80. $11.20 plus $188.80 equals $200. So we're going to write a check for $188.80 payable to Jonathan again, the custodian, and you're going to go to the bank, cash it, and the cycle begins. Our journal entry is going to be a debit to the expenses and a credit to cash. Look at your journal entry. It's going to be a debit to the various expenses and a credit to cash. Once you establish the petty cash fund where you debited petty cash for $200, you are never going to write a journal entry with petty cash in it again, unless you raise the limit or get rid of it. You set it up for $200, you debit petty cash 200. That's the end of petty cash in terms of journal entries. Guess what? When you run a petty cash fund, once in a while, it's not going to come out exactly right. It's very easy to make a mistake, give somebody too much change, too little change. Maybe somebody finds a quarter on the floor and they give it to you and you absentmindedly stick it into petty cash. Well, you're going to be off then. So here's the procedure for handling that. We're going to use a cash short over account. Cash short over account. Now, before we get to the cash short over account, let's look at a cash register, which is similar to petty cash in a way. Change fund, a supply of currency and coins kept in a cash register. Allows the business to make change when customers pay in cash. And at the end of the day, you deposit whatever in the cash register, except for the change fund amount. So just like petty cash, you open up with a box called the cash register that has $200 in it. $200. You set it up by debiting change fund, crediting cash. Debit change fund, credit cash. You'll never touch the change fund again in terms of debits and credits. So let's see what happens here. At the close of the first day of business, there's $1,450 in the cash register. Excuse me, let me just. Oh. These guys must have changed their schedule. It's supposed to be here on Wednesday. Okay. So let's see what we're talking about. We have a change fund. We set it up for $200. At the close of the day, we now have $1,450 in the cash register. Isn't that great? That means that our sales were $1,250. The cash amount was $1,450 minus the $200 we already had to begin with. That leaves us with cash that we generated $1,250. We can now debit cash and credit service fees or restaurant income or food income or something like that. We tied out perfectly. Now, what if we're short or over? This applies to both petty cash and the change fund. We could have too much cash, in which case we're over, or too little cash, meaning that we're short. So let's see what we're talking about. Take a peek here. We have a $200 change fund. We opened up the day with $200. At the end of the day, we had $1,161 worth of cash. 1161 minus 200 means we brought in another $961. That is your debit to cash. The difference in the change fund plus the amount of cash at the end of the day becomes your debit to cash. The only thing is the cash register tape tells us that the sales were really $963. Somewhere along the line, we lost $2. Okay, not much we can do about it at the end of the day. Very easy to do. So we're gonna, this thing is sticking on me now, come on. do it this way. There we go. So look at our journal entry. We debit cash for 961. That is the actual physical amount of cash that we generated that day. Our sales, though, were 963 per the cash register tape, per your computer in your cash register. And we debit an account called cash over short. This is an expense account or an income account. It's either a gain or a loss, cash short or over. Okay. Let's take a peek at the overage here. Well, at the end of the day, we had $1,015 sitting in the cash register. We know we had 200 to begin with. The difference in that would be your cash. We're going to debit cash for $815, but this cash register tells us the sales were only $814. So we're going to credit sales, and that gives us a credit of $1 for an overage. An overage. Debit cash, credit service fees, credit the cash short and over. And that's pretty much it, Jonathan. Not much in this chapter, really, no?
Oh, sorry. I thought I was unmuted the whole time.
That's
But
okay.
yeah, not really.
Yeah, this isn't too tough. The thing is, the bank reconciliations can be tricky. So when you're doing your homework, you'll probably get stuck a little bit. But you'll pick that up. The key thing to remember is that the bank side, there are no journal entries, and the only thing you have on that side are the deposits in transit and outstanding checks, nothing else. It's the other side that's tougher. The general ledger side, when we have to bring in things the bank is telling us, okay?
Okay.
Any questions on this stuff, Jonathan?
Not yet, but if I'm being completely honest, I haven't started this chapter yet.
No. Well, if I was in your case, I wouldn't study it yet either. Let's get through the first exams first. But we have to keep to our schedule. It's up here for the rest of the class. So I'm glad you and Christy had to leave, I guess. I'm glad you were able to join me today, okay? And I guess we'll call it a session, okay?
Alrighty.
You take care, Jonathan. Bye-bye.
Thank you. You too.